Welcome back to Investing Talk Podcast.
Great to be here.
Today we're looking closely at Opendoor Technologies. They're one of the big names trying to change, well, fundamentally change how people buy and sell homes.
That's one. We've got information covering their business model, their most recent financials, a closer look at their overall financial health right now, and, how their stock's been doing, all current as of early June 2025.
So our goal here is pretty simple. Give you the essential information. What does Opendoor actually do? How did they fare last quarter? What's their balance sheet really telling us? And, how's the market treating them?
Think of it as getting you up to speed on Opendoor.
And hey, if you find this kind of analysis helpful, please do subscribe to the podcast, give us a like, maybe leave a comment.
And if you're feeling generous, you could even consider buying us a coffee through the link in the show notes. It really helps us keep doing this.
It really does. Okay, Opendoor. At its core, it's about iBuying or instant buying, right? They sort of pioneered this.
The basic idea is straightforward. They offer to buy your house directly from you.
Right.
Usually do some, light repairs, maybe some updates, nothing major typically. And then they resell it on the open market.
Trying to take the hassle out of the traditional process. Less waiting, less uncertainty.
That's the pitch. Replace the weeks or month of showings and negotiations with a quick digital experience.
So how does that work in practice? What are the main services they offer?
Well, the big one is the instant cash offer. As a seller, you go on their platform, put in your home's details,
Right.
and their system, using automated models, crunches the numbers and gives you a cash offer pretty quickly, usually non-contingent.
Which sounds great. If you need to move fast or just want that certainty, avoids the whole parade of people through your house.
It definitely appeals to sellers looking for that. And they also offer some flexibility. You don't have to take the cash offer.
Oh.
You can also choose to list your home traditionally through their platform, maybe bundle in some repair services or help with closing.
So options. But it's all managed through their digital platform.
Correct. Trying to make it feel more like, an online transaction, simplifying things for buyers and sellers.
Almost like e-commerce for houses. Okay, makes sense.
Yeah.
Let's get into the numbers then. Q1 2025 results came out May 6th. What did they report?
For Q1 2025, the revenue figure was $1.2 billion.
$1.2 billion. How does that compare?
Well, it was actually up 6% from the previous quarter, Q4 of 2024. So some sequential growth there.
Okay, better than Q4.
But it was down 2% compared to Q1 of the previous year, 2024.
So a bit of a mixed picture. Up from the last quarter, but down from a year ago. What about the bottom line? Profitability.
The earnings per share, EPS, came in at negative 12 cents, so $2.12.
Still a loss then.
Still a loss, yes. But importantly, this apparently met what analysts were expecting, and it was a definite improvement from the bigger losses per share they'd seen in prior quarters.
Right, so context matters. Meeting expectations and showing improvement, even while still negative, is potentially a positive sign. Did they give any hint about Q2?
They did provide revenue guidance for the second quarter of 2025. They're expecting between $1.45 billion and $1.525 billion.
Okay, so they're guiding for more sequential growth into Q2. Let's transition now to their overall financial health. This is where it gets really interesting, I think.
It is, because this is where the challenges become pretty clear. Profitability is, it's the persistent issue for Opendoor.
Even with all that revenue, you said $1.2 billion in Q1, guiding higher. That's nearly a $7 billion annual run rate if Q2 hits the mark.
That's right. Huge top-line numbers. But their net profit margin is still negative, around minus 7.5%. And return on equity is also deeply negative, below minus 48%.
Wow. So they're moving a lot of house, a lot of money is flowing through, but actually keeping a slice of that as profit after all the cost, that's the hard part.
That seems to be the core difficulty reflected in these numbers. The cost to buy the house, fix it up, hold it, market it, sell it. It adds up.
Makes sense.
However, there were some bright spots in Q1 on the efficiency front. Their adjusted EBITDA showed significant improvement.
Okay, explain adjusted EBITDA again briefly.
It's earnings before interest, taxes, depreciation, and amortization, but adjusted for certain items. It gives a clearer view of the core operational performance, stripping out some financing and accounting effects.
And that improved.
Improved quite a bit, yes. And their adjusted net losses were also much smaller compared to previous quarters. So, signs of better operational management.
That sounds critical. Maybe they're getting better pricing, managing repair costs, selling faster.
That's likely what those improvements reflect, getting more efficient operationally.
What about cash? Are they burning through cash with these net losses?
That's another interesting point. They actually have positive cash flow from operations.
Oh, really?
Huh.
Despite the net losses.
Yes. It suggests the way they manage their inventory, the buying and selling cycle, is actually generating cash for the business day to day. That's a key strength. Provides liquidity.
That is a strength, especially when you're not yet profitable overall. And short-term liquidity. Can they pay their immediate bills?
Seems robust. The current ratio is mentioned as being around 4.5.
Which means?
It means their current assets, things easily turned into cash within a year, are about 4.5 times their current liabilities bills due within a year. That's generally considered quite healthy. Strong short-term position.
Okay, so positive operational cash flow, good short-term liquidity. Those are good points. But buying houses costs a lot of money. What about debt?
Ah, yes. That's the other side of the coin, and it's highlighted as a major red flag. Their debt-to-equity ratio is around 3.16.
3.16, is that high?
That's considered quite high, yes. It means they're using a lot of borrowed money compared to the value owned by shareholders. Significant leverage.
And the risk there is?
Well, high debt makes the company more vulnerable. If the housing market turns down sharply, or if interest rates go up further, making that debt more expensive.
It could become difficult to manage.
Precisely. It's flagged as a substantial risk factor, especially in the current environment.
Okay, let's summarize the financial health picture then. Strengths. Improving operational efficiency, that positive operating cash flow, strong short-term liquidity, red flags, persistent net losses overall, and that high debt level.
That really captures the tension in their financial situation right now.
Got it. Now let's zoom out. How is the market reacting to all this? What's happening with Opendoor's stock price as of, say, late to early June 2025?
The stock closed at 0.652 cents on May 30th, 2025, just 65 cents.
Wow, okay. That's quite low compared to earlier this year, wasn't it? I recall seeing numbers over $1.
It was. Back in February 2025, it hit lows around $1.32, but recovered to about $1.43 later that month. So yes, $0.65 is a significant drop from those levels.
And that drop seems fairly recent. Related to the Q1 earnings, perhaps?
It seems so. The stock was down almost 5% on May 30th alone. And over the 10 trading days before that, it fell nearly 11%.
So the market reacted negatively to that Q1 report, despite the sequential revenue growth guidance and the improved adjusted EBITDA.
It appears investors focused more on the year-over-year revenue dip, the continued net loss, and perhaps general concerns about the housing market's trajectory.
Were people trading it more actively during these drops?
Yes, trading volume reportedly increased alongside those price declines.
Is there any technical analysis take on this? Charts, trends?
Some short-term technical analysis suggests the stock is in a broad falling trend.
Oh.
And the forecasts based on that analysis point towards potential further declines, unless it finds some solid ground and stabilizes pretty soon.
So technically, it looks weak in the short term. How has it held up over, say, the past year, given these ongoing concerns about profit and debt?
Well, it's definitely faced pressure because of those exact issues, profitability, debt. That's been a recurring theme.
But it hasn't just collapsed entirely.
No, it's shown some resilience at times, and that might tie back to things like the positive operational cash flow we talked about, giving it some fundamental underpinning, perhaps.
Interesting. Okay, let's put Opendoor in context. What's the industry like? Competition, bigger risks and opportunities?
They operate in what you could call the residential real estate e-commerce space. It's still evolving. They compete with other iBuyers, but also increasingly with traditional brokerages beefing up their tech and other digital platforms.
And the whole sector is sensitive to the economy, right?
Yeah.
Especially interest rates.
Hugely sensitive. Fluctuating interest rates directly hit mortgage affordability, buyer demand, how many homes are bought and sold, everything Opendoor's business relies on.
So what are the biggest specific risks mentioned for Opendoor?
3 main ones stand out. First, regulatory risk, new rules could impact how they operate. Second, market volatility, sudden drops in home prices, or big shifts in inventory levels are tough for their model.
If they buy high and the market drops before they sell.
Exactly. And third, just increasing competition. It's getting crowded.
External factors, market swings, competition. Seems challenging. Are there potential upsides mentioned? Opportunities.
Yes, and this is where it gets quite intriguing. Despite the current stock price and the challenges, some forecasts mentioned project potentially significant upside later in the year.
Really? Like what?
One forecast pointed to an average price target around $4.63 by the end of December 2025.
From $1.65 to over $4.60.
And potential highs were suggested even above $9 per share.
Wow. That's a very bullish outlook. What has to happen for that, according to these projections?
It seems contingent on one of two things, or maybe a combination. Either the overall housing market conditions improve significantly, think interest rates stabilizing or falling, more balanced inventory.
A better environment for them to operate in.
Right. Or the company itself demonstrates major improvements in execution, really nailing down costs,
Yeah.
improving profit margins consistently, managing that balance sheet better.
So it's an if situation. If the market turns or if they execute much better. How are investors feeling about this mix right now? Cautious, hopeful?
Sentiment seems cautious to maybe even bearish in the near term. You see that reflected in the recent stock performance and online chatter. The losses and debt weigh heavily.
Understandable.
But there's also clearly some speculative interest bubbling underneath. People looking at those potential high price targets.
Betting on a turnaround.
Betting on that potential rebound, yes, whether driven by the market or the company figuring things out more effectively.
So caution mixed with some speculation on a recovery.
Okay.
Let's try to wrap this up. What's the overall takeaway on Opendoor Technologies heading into summer 2025?
I think the picture is one of a company with a genuinely innovative model in iBuying. They've scaled it impressively. Look at the revenue volume.
Billions of revenue.
They're showing sequential growth recently, guiding for more. And those operational improvements, like better adjusted EBITDA and positive operating cash flow, are important positive signs. They're generating cash from the core business. But the big challenges remain. Consistent net profitability hasn't been achieved yet, and the debt level is high, posing a real risk.
And all of this is happening in a tricky housing market, influenced by interest rates, with lots of competition.
Exactly. Internal financial hurdles combined with external market pressures. The stock price seems to be reflecting that difficult combination right now.
Down significantly, technicals looking weak short term.
Yet you have these forecasts suggesting substantial potential upside later in the year if things break right for them, either externally or internally.
So it really is a story of weighing the current operational strengths and improvements against those significant financial weaknesses and market risks.
That's the core tension. Progress in some areas, significant challenges in others, set against an uncertain backdrop. Understanding that balance is key.
Which leaves us with a final thought to ponder. You have these forecasts out there suggesting, potentially massive gains later this year if the market recovers or the company really steps up its game. But at the same time, the current stock trend looks weak, technically pointing down. So how do you weigh those things? How much importance do you give to short-term market signals versus a longer-term story based on potential fundamental improvements or a market rebound?
That's the puzzle. Something for you to consider based on everything we've discussed today.
Definitely something to think about. That brings us to the end of this look at Opendoor Technologies. We hope breaking down the numbers and the context has been helpful for you.
Thanks for tuning in.